Great. Great. Thank you so much. Great. So then this is what I'm doing, ladies and gentlemen, and you'll be able to assist me to reshare the document all the times that these students need these papers. You must always share with them. So we are looking at what we call capital structure theories. Very, very important. And in these capital structure theories, it will be you telling me, because I know you know this, you are making a choice between debt and equity. Between the two, which one is a better source of finance? Should we go for more of debt or more of equity to increase farm value? We shall always consider what we call debt. Debt, so long as debt is used optimally, then as an organization, you really reap lots of benefits. Why? Because debt, we normally pay the debt holders interest, and the interest is tax allowable. Interest is tax allowable. Equity holders, we give them dividends. Dividends, you can never knock dividends from your incomes to get taxable profit. Dividend is an appropriation. It comes after you have computed profit after tax. So dividends is never tax allowed, never allowed for taxation. But whenever we talk of interest, which is paid on debt, interest, whenever you take a loan, whatever interest you pay, if you are an organization, that interest will shield you from higher taxes. There is also another reason why people prefer debt. If we go for debt, then automatically we shall not be able to dilute our control. So the ownership, the share ownership, farm ownership remains. We are only working with people's money, and then we shall be able to do what here? We shall, ladies and gentlemen, be able to get the money paid back, and then the old shareholders, the original shareholders remain. It will be very important for me to tell you the question that I'll be doing from now. Yeah, it will be very important. The past paper that I would want you to look for, my good students, where is it? It is December 2025. December 2025, question number 4C. Please get it. December 2025, question number 4C. That is the question that I'll be doing. It is the question that I shall be doing. Not now, but just open it up, just in case. You will need it. You will not be suffering a lot. You won't be suffering a lot looking for it. All right, ladies and gentlemen, great. Now we can continue here. 6 new messages. Oh, we share the question. Mike wants us to share the question. Somebody should be able to assist me do that. The notes, even the notes, somebody should be able to assist Mwalimu do that, because already you have it. So capital structure refers to the mix of debt and equity financing used by a firm. It is influenced by business risk, access, control, flexibility, and market condition. You see, as much as you're saying that debt is very, very good, if it goes through the roof up there, then the risk will really increase. Yeah, but for taxes, of course, we know that debt will be much better. And also for business control, if it's RCM, and assuming I own RCM, if I want more finances, if I look for another person to come and join me on board, that means me ceding some control. But if I borrow from a bank and I utilize this money well, I'll be able to return. And then, of course, in this case here, so debt is very, very good. Yeah. So theory, we have so many theories. We have what we call the net income theory. If you're writing down, you'll have to write them just high level. NI theory. It's net income theory, which assumes the first assumption is that under net income theory and the net operating income theory, there shall be no taxes at all. No taxes at all. All right. So we have in this case here the traditional theory. Yeah, very, very important as well. But where your examiner will be able to get your questions always, it is in what we call Modigliani Miller propositions, where we shall start with MM1. Whenever you hear of Modigliani Miller proposition number 1, we're supposed to appreciate that under MM1, this is a world without taxes. So MM1, no tax. Value is independent of leverage. Value is independent of leverage. Just a minute, I've seen some ninja who may mess up my PDF, disable annotation for other CAs. And this is the same as net operating income. So when I teach you MM1, I will not be teaching you this net operating income at all. I will not be teaching you this net income operating at all, because MM1 is the same as NOI theory. Then we have MM1 with corporate taxes. This is supposed to be MM2 with corporate taxes. So MM2 with corporate taxes, very, very important. Then we have MM with personal taxes and MM with taxes and financial distress. We shall look at each one of them slowly. I will not be in any hurry to teach this, because this really is important, because it also affects, in this case here, your real estate knowledge, which will be our last topic now. Modigliani and the Miller proposition 1, MM1 without taxes, also known as the net operating income NOI. Concept and assumptions. Modigliani and the Miller first propositions, MM1, states that the value of a firm is independent of its capital structure. It doesn't matter how you raise your funds. You can decide to have your organization financed 100% by debt, or 50% debt, or 100% equity, and still the firm value will always remain the same, because according to Modigliani and Miller 1, the firm value is independent of its capital structure. Whether financed by equity only, that's unlevered, or by a mixture of debt and equity levered, its total market value remains constant, provided there are no corporate taxes and the capital markets are perfect. This proposition is identical to the net operating income approach in traditional theory. Underlying assumptions. These assumptions, most of us may not be able to remember all of them. But the most important assumptions I would want you to always remember. The number one assumption, ladies and gentlemen, is that there are no taxes whatsoever, neither personal nor corporate, because MM1 is operating in an environment of zero taxes. Environment of zero taxes. That is so important for us to master. Number two, I would always want you to appreciate this, that the expected EBIT of the firm is constant and perpetual. Is constant and perpetual. The expected EBIT, that is earnings before interest and tax, operating income of the firm, is constant and perpetual. Ladies and gentlemen, assuming in this case here you are to answer my questions very nicely, and then of course I decide to give you some money. So if I was to decide to give you some money, it's a lot of light, don't worry, I'll be able to take care of the light excess. So in this case here, if I decide to give you some money and I'm giving you 10 million shillings every year, I give you 10 million shillings every year without an end in sight. There is no definite period. So basically, n is what here? Basically, n is infinity. Basically, n is what here? Basically, n is infinity. So if n is infinity, right? And then, ladies and gentlemen, I'm giving you some cash flow. I'm giving you some income of 10 per annum, and n is infinity. And then I tell you, hey, the cost of capital, the cost of capital is 10%. What will be the value? Your total value. So n is infinity, and the cash flow that I'm giving you is 10 million per annum. And the cost of capital is 10%. And I want you to give me the total value, or basically the present value. Are you able to give me this figure? Or basically the present value. I'm here. I mean, all eyes are on you. So the present value, right, will be 100 million. What has this ninja called Chris done? What Ninja Chris has done is known that in this case here, you will take the cash flow given, you divide this by what year? You divide this by R. The cash flow given, you divide this by R. Whenever n is infinity, ladies and gentlemen, you will take the cash flow given, which in this case here is 10, you divide by 10%, which is 0.1. That is when n is infinity, which will give me, 100. Great, which will give me 100. The same will apply for these organizations. Now, my students, please listen and listen to me very well. We have a situation where this organization will be getting an income. And this income it will be known as EBIT, what we call operating profit, EBIT, earnings before interest and tax. And for you to be able to get farm value, in this particular case, we shall always be taking the EBIT, we divide by what year? We divide by R. We take EBIT, divide by R. EBIT divided by R. So then you must be making an assumption that these organizations will be staying with us forever. That is why in this case here, I want to start very correctly here by telling you that we are making an assumption that this organization will be staying with us forever, indefinitely, and therefore to get its value, you'll be taking EBIT over the required return. And the required return here will be WACC. I'll come back to that. This is really interesting, ladies and gentlemen. So there are no taxes, and this expected income of the farm is going to be constantly received, and it shall be perpetual. And then, of course, we have what we call information symmetry. Information being symmetrical. All investors have equal access to information. And then, of course, we have these other ones here that there are no transaction costs, no flotation costs, or any bankruptcy costs. We call these assumptions of capital, or rather perfect capital markets, which don't exist. I mean, capital markets are there also to make some money. There'll be some transaction costs, right? But in this case here, we are saying that, no transaction cost, no flotation cost, no what year bankruptcy costs. And then these one, of course, you're not able to remember it in the exam. Investors and farms can borrow and lend at the same rate of what year interest. It's not very tough. But as an individual, as an organization, you'll be able to borrow these loans at the same rate. There will be nothing like preferential interest rates for other people. No. So, gentlemen, the assumption that I will never forget about this Modigliani Miller one: number one, no taxes. Number two, we have information being symmetrical, having access to all the information that is available, right? And then we have this operating income is not in advance and will remain constant indefinitely. And then if you'll be in a position of remembering this concept of interest rates being the same for both individual investors and organizations, it will be pretty good, right? So then we continue. My greatest students, best students here. I don't want to add you any other assumption. The main proposition of Modigliani Miller one, that the total market value of a farm is determined solely by its operating income and the overall cost of capital, not by its debt equity mix. Ladies and gentlemen, the most important thing that I would want to sell to you here this evening, whenever you hear about Modigliani Miller one, whenever you hear about Modigliani Miller one, whenever you hear about Modigliani Miller one, you shall always remember that value of a levered farm will be equal to value of an unlevered farm. Sorry for that, just a minute. How about now? How about now? I don't know whether you're still straining to get me. Hi. Am I audible? Okay. Now it's okay. Great. Thank you so much. Thank you so much. So value of a levered farm will be equal to value of an unlevered farm. Yeah, because the capital structure is irrelevant. So right there, this is value of a levered farm. Levered. Value of a levered farm. And then U stands for unlevered. Unlevered. U stands for unlevered. So we have value of a levered farm will be equal to value of unlevered farm. And how do we get this value of an unlevered farm? My good students, to get value of unlevered farm, you'll always take a bit divided by W ACC. A bit divided by W ACC. Which is the same as the analogy of the 10 million that I gave you. We say 10 million divided by R. The same. This organization is always giving us a bit. So we take a bit, earnings before interest and tax, we divide by what we are calling WACC. And I shall be able to go to the personal non-personal but question first. An illustration first here. This illustration will be able to answer everything that we are talking about here. Illustration of the MM1 without taxes here. This one here, MM1 without taxes here. So we are given an example there of two farms. Farm A is unlevered. Unlevered organizations are those organizations without debt. So farm A is unlevered and the farm B is levered. You can even see here debt. Farm A is nil and this one here is having a debt. So they want us to compute farm values. They want us to compute farm values. So, ladies and gentlemen, computation of farm values, there is something that I would want you to appreciate here. Something that I would want you to appreciate. Whenever they tell you to calculate farm values, first, you must start by giving us value of unlevered farm. Value of unlevered farm. You always give us value of the unlevered farm. Value of the unlevered farm. It's always important. Regardless of the Modigliani Miller proportion you're using, you shall always start by giving us value of unlevered organization, which is farm A here. Please listen. You can see the EBIT has been given 1 million and WACC is given as 0.15. So my work is to appreciate here that this EBIT will be constant every year, 1 million, 1 million, 1 million in perpetuity. There is no n given. And I can see the WACC here. So what I'm going to do, ladies and gentlemen, is to calculate this value of the unlevered organization, which I'll be able to get pretty easy. How do I get this? How do I get this? So to get this value of unlevered farm, so we have value of unlevered farm. The formula is very easy. You take the income, you capitalize by dividing by WACC. So we have 1 million, which I'll divide by WACC given there, which is 0.15. So are you able to give me this figure, my good students? Remember, EBIT in the question given is 1 million. You divide by 0.15. Please let me know how much is the value of the unlevered farm. So according to Kevin, he's getting 6 million, 666, 667. 6,667 point what year? 66 what year? 667. All right. So all of us, are we able to get that figure, ladies and gentlemen? Value of the unlevered organization. Thank you so much. Thank you so much. So in this case, we've been able to value the unlevered farm. How about value of this other organization? Value of the levered farm. Value of the levered farm. Value of the levered farm. Is there somebody who can give me? Remember, it's Modigliani Miller 1. It's Modigliani Miller 1. It's Modigliani Miller 1. How do I get value of a levered organization? Abracadabra. Value of a levered organization. Same amount. Thank you so much, Kevin. That if it is Modigliani Miller 1, there is nothing like looking for the value of farm 1 and the value of farm 2. No. It doesn't matter whether you are levered or unlevered. Value of unlevered farm will always be equal to value of what here? Levered farm. Yeah, great. So then you mentioned there for me that according to who? According to who? According to MM1. According to MM1. So according to MM1, value of unlevered farm should always be equal to value of what here? Levered organization. So meaning that the value of the levered organization will also be what here? Somebody 66667 like that. All right. Iko jamaa ananiambia hapo mwalimu simame. Hii bodi ya nyumbani ni fupi sana. Nikisimama nilifika hapa. Kuna limitation. Hii bodi ni chini sana hii. But so long as you're able to follow, are you able to follow? Unajua kuna kusema simama ama namna gani? So long as you're able to follow. Again, hata ikitoka kusimama kwa teaching ni kama slavery pia. Inafaa mwalimu anaweza keti chini. Anaweza simama. Yeah, we continue. Yeah. We continue. Sababu nikisimama niko tolo kushinda the board. All right. All right. Thank you so much. So according to MM1, value of unlevered equals value of what here? A levered organization. Now I would want us to do a summary. Let's do some summary here. Let's do some summary here. And the summary that I want us to do, ladies and gentlemen, is this one here. Very important summary. You must always give us this summary whenever the examiner asks you. So this summary, we shall talk of equity, we shall talk of debt, like that. Equity and debt, and then we have here farm. So we have farm A, which is unlevered. Then we have farm B, which is levered. Yeah, and then of course we have the total here, very important. Total. You must always give us that summary there. You must always give us this summary. So farm A ndio umeniambia total yake ni 6666667. Na hii pia ni 6666667 like that. Farm value. That summary is really important. Really important. Now, let me ask you a question. What is the debt of farm A? Let me share the question. What is the debt amount of farm A? The name unlevered speaks everything. Debt of farm A here is 0. Debt of farm B is 4 million. So debt farm A is 0. Debt here is 4 million. 4 million. 4 million like that. Now, can you then kindly give me the equity amount? Equity amounts. One thing that you're supposed to appreciate from the word go is that equity plus debt shall always be equal to total. So for instance, for farm A, balancing figure, it means that the equity here will be like that. The equity will be like that. How about in this case here, farm B? Equity for farm B. It means equity plus debt must be equal to total. So if you are following, you'll be able to see that the equity for farm B is 2,666,667, like that. So that summary is really important. That summary is really, really, really important. The summary there is really, really important. The summary there is really important because we know the total farm value. Now that you know the total farm value, you can get the balancing figure for equity by balancing it with debt amounts. By balancing it with debt amounts. So once you reach there, I'm really, really okay. I'm very, very comfortable. Very, very comfortable. Very comfortable. Thank you so much. Now, ladies and gentlemen, let's try this question before we go to, this concept of summary is the one where we verify the components. You'll be able to see how important it is. You start by giving us the total values. Then you go to debt. You see, debt never fluctuates. The balancing figures will always be the equity values. Equity values. So both firms are identical in terms of total values, proving that leverage has no effect on the overall value. So even if you took debt of $1 million, debt of 5 million, debt of 10 million, doesn't matter, still the farm value will be that 6 million thing, 6 million, 6 million. With your permission, I'll be able to take you through what now we call Modigliani Miller, the other side of the coin. MM2 with corporate taxes. In their original model, MM ignored taxation. That is MM1. In 1963, they amended the model to include corporation tax. This alteration changes the implication of their analysis significantly. More importantly, for financial strategy, the higher the level of company gearing, the greater the value of the company. So whenever there are taxes, then the debt tax advantage will be really high. Yeah. So whenever there are taxes, debt will give you an advantage. That advantage translates to a higher value. Translates to a higher value. The logical conclusion is that companies should choose 99.9% gearing, the level where taxes exist. Actually, it should be when we are dealing with taxes, choose to finance your operations by 100%. 100%, if possible, of course, there must be a shareholder in the company. That's why they're taking it 99.9. Geared companies have an advantage of ungeared companies, i.e., they pay less tax and will therefore have a greater market value and a lower WACC. MM argued that in the world of taxes, the interest on debt being tax allowable shall increase the value of the firm. According to MM, there are two important formulas that you must cram. According to MM, please write these formulas. You must cram these two formulas. You must cram these two formulas. These ones you must cram them. Hakuna njia ingine. You must cram these two formulas and they look like this. That is MM2 formulas. MM2 formulas. MM2 formulae. So these MM2 formulae, how do they look like, my good students? There are two of them. That value of a levered farm. Value of a levered farm equals value of unlevered plus DT. Plus DT. In formula number one. Formula number one. Value of a levered farm equals value of unlevered plus DT, where D is debt amount and the T is taxation. Debt amount and the taxation. Thank you. And then formula number two, you must always calculate cost of equity of a levered organization. Those two formulas. Whenever you see, like last semester, they gave us no, actually it wasn't like this. Yeah, but whenever you see a question mentioning MM2, Modigliani Miller proposition with taxes, you must start by writing down these two formulas. Yeah, where KEL will be equal to KU plus into brackets here, KU minus KD. into D over E into 1 minus tax like that. Into 1 minus tax like that. I'm so sure the second formula normally scares a few of students, but it's not that bad. First of all, write it. Write it. KEL. KEL is cost of equity of a levered organization, which equals KU plus into brackets KU. This is KU. KU. The same KU here. KU minus KD. And then we have D over E, which of course has to be adjusted for what year? For taxes. I know you haven't understood the formula whatsoever, but the moment you write it down, would you kindly mention there why for yes? Looks like Hamada somehow. Yeah, the moment, yeah. So KU plus KU minus KD into debt of equity into 1 minus tax. Thank you so much. I told you today's session will be so interesting, but I can see we forgot to go for prayers. We forgot to go for prayers. We forgot to go for prayers, which is very, very sad. I will never repeat that. Yeah, so please, any Muslim student who is around, please, much apologies. Yeah, rest assured that I don't know how even, we forgot because we came in a little bit late. Yeah, we came in a little bit late. So those two formulas are really, really, really important. Really, they're here. KEL, Q plus into brackets Q minus KD, D over E into 1 minus tax. What does Q stand for? This Q stands for what here, somebody? Cost of equity of unlevered organization. 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 Very good. So we are told the illustration, consider two firms, L and U, with the following features. So we have EBIT, LU, cost of equity, yeah. Then we have in this case here 8% debt. I think there is a problem here, misalignment problem. This cost of equity of a levered firm is supposed to be dash. Sorry for that. You can now copy this entire table afresh. Cost of equity here is supposed to be dash, so that debt is 5 million, and then the rate of tax is 30% for both organizations. Both organizations. You can see the unlevered farm debt is 0. Unlevered farm debt is 0. There is some misalignment. So here is supposed to be cost of equity dash 10% unlevered. And then we have 8% debt, 5 million dash. Then the tax rate is 30% for both organizations. So they want me to calculate the value of each firm and what they're calling WOT here, what they're calling WACC. So then very fast, I'm a bright student. I'll be able to remember very well that, hey, this is Modigliani Miller 2. This is Modigliani Miller 2. Can somebody tell me, why do you think, am I saying it's Modigliani Miller 2? Why do you think, am I saying it is Modigliani Miller 2? Why do you think? Why do you think? Am I saying it's Modigliani Miller 2? All right, yes. It is because, ladies and gentlemen, we happen to be having what here? Taxes. Thank you so much. We have taxes. And if it is Modigliani Miller 2, I will start by writing those two formulas, which I suppose there must be a ninja who has forgotten those MM2 formulas. I suppose. Let me rub them and then, of course, trust you that you guys are doing the right thing. Let's see whether we'll be able to write the formulas of Modigliani Miller 2. Modigliani Miller 2. Modigliani Miller 2. The two of them. Don't leave any out. And once you finish writing, and then you happen to be very honest, you have not looked at any place, and you are right, can you kindly mention there why for yes? So that I can continue. If you remember those two formulas, you are a great ninja. You're a great ninja. Let me start by writing the first one. If it is MM2, where we have taxes, ladies and gentlemen, we must remember value over a levered farm equals value over unlevered plus DT like that. Very, very important. And then the second formula is the one ya kevo, ya kel, equals ku, plus ku again, minus kd. It doesn't stop there. It will be debt over equity. So many guys forget and say debt over tax here, into 1 minus tax. Very important. So whenever you discover that you're dealing with MM2, don't forget to start by giving us those two formulas really. Those are really important. Now, once you do that, always, and I always insist this, you shall always start by valuing unlevered organization. Always, regardless of the model. Start by valuing unlevered organization. So we start by valuing unlevered. So mention there, value over unlevered. Value over unlevered company. So we have here value of unlevered company or firm, what we are calling VU. Is there anybody who can try giving us the formula for VU? Just try, even if you don't get it right. So what? Just try. How do we get VU? Just try. Because value is based on income. It's based on income. Very important, ladies and gentlemen. Please check this out. So remember, this time around, you have taxes. Don't forget that. We have taxes. And when you have taxes, then you must give us what we call profit after who? Profit after tax. Profit after tax. Yeah, you start by valuing unlevered farm. You give us profit after tax. How do we get profit after taxation? So in this case here, value of unlevered farm will be EBIT into 1 minus tax, like that. Now, once you do this, please listen. Please listen. You know, somebody may ask me, Mwalimu, why are you not deducting interest here from this? Because ideally, to get profit after tax, I should deduct interest. Can somebody give me an answer? A bright student, all of you are bright. Why am I not taking away interest out of this EBIT when desiring to get my PAT? There is no debt. Thank you so much, administration. There is no debt here because this organization is unlevered. So ukianza kusema at minus interest, you're wasting your time. You're wasting your time. Now, please, ladies and gentlemen, this PAT belongs to who? Once I do this, I'm getting profit after tax. Profit after tax, does it belong to debt holders? Profit after tax. Will the debt holders have any interest in the profit after tax? No. So there is no way I can use WACC here. So here I can only use KU because, ladies and gentlemen, profit after tax belongs to ordinary shareholders. Because I've always seen examiners confusing you. They give you a question. Students are used to, you know, MM1, please listen. MM1, we call it net operating what? Net operating profit. Skiza, MM1, we called it net operating profit. And the operating profit model, you see, we don't deduct tax. We take EBIT. This EBIT belongs to two stakeholders. EBIT belongs to ordinary shareholders, equity holders, and EBIT, you can see, has interest in it. It also belongs to who? Debt holders will get a share. And that is why for MM1, for NOI, net operating, we normally divide by what here, sample W? ACC. Because you see here, we are not, here we are getting what we call the final profit. And the whole of this profit will go to equity holders. So whenever we talk of MM2, value of unlevered farm, it will be EBIT after tax, of course. But now you divide the whole of it with what here? Cost of equity, unlevered organization. Because there are no debt holders here. You see now, ladies and gentlemen, you guys are great finance people. I mean, how do we get WACC? To get WACC, we normally take weight of equity, cost of equity, plus weight of debt, cost of debt, into 1 minus what here? You see now here, WACC, we have debt holders. We have debt holders. In an unlevered farm, we have debt holders. Unlevered farm, we have debt holders. No, please talk to me. You must talk to me. For unlevered farm, no debt holders. And that is why for unlevered farm, please don't confuse. This will knock you out if you confuse. For unlevered farm, we normally talk of what here, somebody KU like this. KU. Very, very important for us to be able to really appreciate this. Very important for us to be able to appreciate this. So then go and look for this unlevered organization. We have this unlevered organization. We have this unlevered organization. So when you look at this, the unlevered organization is this one here called U, unlevered organization, whose EBIT, I can see it is 1 million. I can see EBITDA is 1 million. I multiply by 1 minus T. I can see its tax rate is 30%. So 1 minus 0.3. And then I'll be able to come and divide this by cost of equity of the unlevered farm, which is 10%, which is 10.1. So is there somebody who is able to give me, ladies and gentlemen, this figure? Anybody who is able to give me this figure? So Paris gives me 7 million. Paris gives me 7 million. Paris gives me 7 million. Everybody's getting 7 million, isn't it? Thank you so much. So if I were you, I would start mastering this. When I go to an exam, the examiner tells me, hey, calculate in this case here farm value using MM1, using net operating. That one I know it's a bit of a WACC. When they tell me use Modigliani Miller 2, I know it will be after tax, earnings after tax, divided by Q. Once I get that, my brothers and sisters here, then now I will be at home. Automatically, I will be at home. Once I get that, the second step now will be for me to apply the first formula. So in this case here, the second step will be for me to get value of a levered farm. How do we get this value of this levered farm? We take value of unlevered plus DT like that. We take value of unlevered plus DT. Yeah, we take value of unlevered plus DT. I'll be able to add on there. So in this case here, value of unlevered plus DT. So the unlevered farm that we have here has a value of 7 million. And I can see the levered farm has debt of 5 million times tax itself, which is 0.3. Times tax itself, which is what here? 0.3. Times tax itself, which is 0.3. So then I'm going to get value of this levered organization. You see, if you look at the levered farm, which is the second farm, it has debt. This was a misalignment. 8% debt of 5 million. It has debt of 5 million and tax is still 30%. So whenever you want to get value of a levered farm, you will take value of the unlevered, which you have computed here, 7 million, plus the debt itself, 5 million, times tax of 0.3, which will end up giving me what figure at the end of the day? You guys are not talking to me now. You're not talking to me. You're not talking to me. You're not talking to me. According to Pius, he is getting 8.5 million like that. Now, a student there has told me, Mwalimu, repeat, but before I repeat that, I want you guys to do for me that summary table. I want you guys to do for me that summary table. There is a summary table that will be very important to be understood by every student who is going to sit for this exam. There's a summary table you must do for me. There is a summary table that you must do for me. There is a summary table that you must do for me. Can I give you the general structure of the summary table? Can I give you the general structure of the summary table? Yes. So this summary table looks like this general structure. Actually, I even want us to change it slightly. I want us to change it slightly. So we have got two farms. So farms, I want us to change it slightly. So farms, we have U and L. So give me the total value first. Total value, total farm value. So this is 7 million. And this one, ladies and gentlemen, you've just given me a figure of 8.5 million. I want us to change this summary table slightly. Yeah, we always keep on improving. Then come and give me, in this case here, the debt. Let's change this slightly. Debt. What is the debt value of the unlevered farm? What is the debt value of the unlevered farm? 0. How about the debt of the levered farm? Our question here, debt of the levered farm, 5 million. So then the equity automatically becomes a residue. Equity. So equity will be total value minus debt. Equity will be total value minus debt. So the equity for the unlevered will be 7 million here. And this one will be 3.5 million. Let me know now whether you are able to do what here to understand this summary table. Let me know whether you're able to understand, because you see, to get the equity, you take the total value minus the debt. You have to pay debt. If you're able to understand this, please mention there Y for yes, or N for no. Thank you so much. So that is really, really important. Now, let me ask you a question. For this unlevered organization, I would want you guys to give me the weights. Give me the weight of debt. You can even write inside here. The weight of debt for the unlevered. So unlevered organization weight of debt will be 0 divided by the total. 0 divided by the total, which will be 0. How about weight of equity? So weight of equity will be 7 million divided by 7 million, which gives me what here, somebody? Which gives me 1. Because the examiner will always want you to calculate the weights. Are you able to give me the weights of the levered farm? Let me give you 1 minute. Please give me the weights of the levered farm. Give me the weights of the levered farm. For the levered farm, give me the weight of debt. Give me the weight of debt. Levered farm. Try your best. Just try. Even if you don't get it, so what? So what? Even if Charles Ndambuki. Kevin, I like your speeds. 59. 0.6.4. But were you able to take, like now for debt, it will be 5 over 8.5. Right? And then the weight of equity will be 3.5 over the total here, which is 8. If you wish, you can write this in decimals or whatever. If you wish, so just leave it like that. All right. Now, ladies and gentlemen, remember under MM1, let me just remind you here. Somebody told me to repeat. It's always good to repeat this. Under MM1. So under MM1, to get value of a farm, let me just mention it as value of unlevered. All right. You simply take the EBIT, which is there, you divide by what here, somebody WACC provided. And this value of unlevered farm will be equal to value of what here, somebody levered organized. That's under MM1. But when you go to MM2, value of unlevered now becomes profit after tax, which will be EBIT minus not interest, but minus tax. So it will be EBIT minus tax, so 1 minus T, like that. All over, in this case, what here? Q, cost of equity, unlevered organization. Once you cram it that way, will never ever go wrong. Never ever go wrong. Then, of course, somebody will ask me, Mwalimu, why we using WACC here, and yet this is value of unlevered farm. Later on, we shall be able to see that WACC will always be equal to WACC of unlevered. What we shall be calling WASHU equals Q, but this will come later. For now, just master this that way. So we have been able to apply Formula 1, value of a levered farm, but remember Modigliani Miller 2 has got two formulas. Value of a levered farm, and then we have KL equation. It is the KL equation where we draw the line. Most students, whenever we talk of KL, we normally draw the line. KL will be equal to what? Let me see. So now you are equation. So in this, second equation, we are getting the second equation. Thank you so much, Lister. You're really good. Really good of you. And the KD is the interest rate given, the 8%. KD is the rate of interest provided. So Q, cost of equity of unlevered, is 10%. KD is 8%. So 10% is the same as 0.1. So we have here 0.1 plus 0.1 minus KD. You see 8% is the same as 0.08 times. Are you able to see the debt amount? What is the debt amount from the summary table? Debt amount of the levered farm. Summary table, debt amount. Five. So 5 million over 3.5 million into 0.7. Into 0.7. Into 0.7. Into 0.7. Hata ujaona nimetoa 0.7 wapi? Ujaona nimetoa 0.7 wapi? Ujaona hata. Kelvin gives me 12%. The final answer is supposed to be 12. But have you seen where I got the 0.7 from? Because of 1 minus T. Suppose KD was admin. Remember, this 1 minus T, they are basically putting it on debt. So even if your KD is after tax, they are basically putting that on debt. So that 1 minus T must always be applied. Must always be applied. 1 minus T, thank you so much. So is everybody able to get the 12%? Is everybody able to get the 12%? Is everybody able to get the 12%? After you use your bracadabra, thank you so much. Thank you so much. Now, ladies and gentlemen, I would want you to look at the question. Look at the question. Calculate the value of each farm and the WACC. So I want you guys to give me the WACC of the unlevered farm. Let's start from there. WACC of the unlevered. WACC of the unlevered farm. So we have here WACC unlevered farm. So WACC, to get it is very easy. WACC is weight of equity, cost of equity. Weight of debt, cost of debt after tax. Weight of equity, you guys, if you look at your summary table, you gave me cost of weight of equity to be 1 because the farm is 100% equity financed. Cost of equity is 10%. This is 0 because you see this unlevered farm. Unlevered farm. So then this one will end up giving me 10%. So meaning that washu equals KU. If you remember very well, the cost of equity of unlevered farm was 10%. And when they want us to calculate weighted average cost of capital of unlevered farm, I don't have to do any calculations. For unlevered farm, I will never ever do any calculations because washu will always be equal to KU. What I just need to remember is this. Washu equals KU, which in this case is what percentage there, which in this case is 10%. And now with your permission, I'll be able to get the WACC for a levered organization. So go ahead and give me the WACC for a levered organization. WACC for a levered organization. Are you able to really get these? And today, because all of you are at home, I would request we stretch with this topic up to 9 p.m. Up to 9 p.m. Leo hakuna wasiwasi. Up to 9 p.m. so I can just finish the entire topic, and then when we meet or again we are meeting. Yeah. Remember, every day of Easter we are meeting. Every day of Easter we are meeting. I just need to finish this. Iko mwanafunzi bado hajafika nyumbani. Iko mwanafunzi hajafika nyumbani mwenye atakuwa na wasiwasi, atachelewa town. Hajafika home bado. Nani huyu? Ala, Joan uko job. You work for a hostel ama nini? Mwingine ako garage, huyu ako town. What happened? Still in office. Okay. Then we can't stretch a lot, but we shall be able to reach 8 so I can do the question that came last semester. All right. From tomorrow. All right. Niko nganya namaanisha namna gani? Kwa gari niko line ya mat. And most probably you line ile ya Super Metro, you go hapo Commonwealth chini you go hapo Stanbank. You line you. Then you must be doing the best marketing for RCM. You must be doing the best marketing for RCM because anybody who's behind you anashangaa huyu jamaa anasoma class gani. All right. Yeah. So then allow me, we finish this and then we discuss about the class times for Easter. Is that okay? We finish this. But basically, we shall always start with the AMA. AMA class will start at 7:30 every day, 7:30 for the 4 days. Yeah. And then maybe we follow with the AFM. I don't know. We shall discuss. We shall agree. But we are going to discuss, because this will basically is that which will be a bit bad for the physical students, that I'll be able to do all the Easter classes from home. I'll be able to do all the Easter classes from home. Wanafunzi wa physical, is that okay? We are doing all the Easter classes from home. Wanafunzi wa physical, please mnisamee. I also have teenagers. At home. I don't want to lose that touch. I have teenagers at home. They have it. All right. Okay, wait. I don't want to lose touch with these young people here. Watakuja kusema, Dad, you are chasing for money. Yeah. Very good. So WACC for the levered farm. So this one will be very easy. How do we get this? So to get this, we'll take the weight of equity, cost of equity of a levered farm. plus weight of debt, cost of debt into 1 minus tax. So weight of equity is what you guys gave me as 3.5 all over 8 million. All over 8.5. 3.5 all over 8.5. Cost of equity levered farm is the one you used the formula. You got this as 12%. Weight of debt is 5 over 8.5. Cost of debt is 8% times 0.7. Seven point, 7.9, 7.9. So are we able to get that 7.9? Wanjiro, how have you read my mind? Wanjiro, come out. I mean, the process of adopting kids, imagine. Kids, but now they have to be very young for 5 years, For 5 years. So I'm following this normal procedure. It's quite tough to adopt, All right. You guys are not giving me answers. You guys are not giving me answers. (8.16%). 8.16%. AA is getting 8.24. AA is getting 8.24. Please check the person who got 8.16. I'm told it's supposed to be 8.24%. 8.24%. Yeah, please check. So then in this case, according to MM2, that is good. That is good. Why? Because you can see the farm value of this company with debt is higher. The company with debt has a higher value. Company with debt has a higher value and a lower WACC. And a lower WACC. Yeah, the decimals really matter. That's why I used fractions, That's why I used fractions. I like leaving it as fraction. I like leaving this as a fraction. Now, my good students, please listen and listen to me very well. My good students, please listen and listen to me very well. Yeah, listen and listen to me very well. You see a note, start by valuing and leave at farm. Don't forget that. Yeah, 8.5. We have that 12%. 8.24 is very, very correct. That somebody thing is like that. Very good. So this illustration number 2 must be done by everybody. Please take a screenshot of this. They've given us tax rate of 40%. All right. Then they want us to give them value of each farm and WACC using proposition 40%. 40%. So you can see we are confusing you by giving you 2 million here and to confuse you. So this 2 million for the levered is irrelevant. Because you're calculating VU, then to get VL, you take VU plus DT, and then you continue with that. Yes. Now, of course, you guys are really good. Really, really good. So please take a screenshot and ensure, don't forget this, ensure that you do this question before you sleep. Otherwise, give me a title there, the arbitrage process. If they say is it 1 or 2? Thanks, Kevin, for asking that question. You look at the environment. If this environment, the question has got tax in it, then automatically that is MM2. Automatically that is MM2. Like now this one, This one you can see calculate the farm value, yeah, and WSCC using proposition, and they're giving you what given here tax rate is provided. So this must be MM, that must be MM2. So I've shared the question so that that ninja can easily take up what here, can easily take up a screenshot, and then we continue. Have you done that? Can I continue now? So like last semester, most students got a fail simply because they were not good with this arbitrage. With the class be uploaded today. Okay. I'll be able to start looking at those uploadings. Yeah. But you've been in the class and you've really been following very well. Why do you need this video? You've been in the class, you've been following very well. You still need to go and waste time to watch this. Or maybe another video. Sawa. Maybe another video. Arbitrage process. This question, we brought it last semester and it wasn't okay. Then I will be able to upload because of that. Yeah. This question, we brought it last semester and it wasn't done very well. So if I'm an examiner, okay. Okay, fine. Sorry for that. Yeah. So then I will be able to upload immediately, actually. I'll be able to upload. We need to just introduce a section for Dr. Aura and then you upload those videos. So they gave us this question last semester. Let me just share this question. It wasn't done very well. And so as an examiner, if I was an examiner, then automatically I would have tried to see whether students have now been able to master it. Really a very easy question. You see this question 4C last semester. Question 4C last semester. They gave us 10 marks for free. The following data relates to two companies, Sigma and Delta, which belong to the same risk class. So you can see number of shares, etc. Using suitable computations, demonstrate how Modigliani Miller approached without taxes, so MM1. An investor holding 10% of Sigma Limited will be better off by switching his holding Delta Limited. Yeah, 10 marks. Okay, sorry for that. Yeah. So arbitrage is common. It came last semester, it was done very, very poorly. So meaning that your examiner this semester, they decide in this case to do what here, repeat this concept. So then it can only be good if in this case here, we are able to do what, first of all, tell students what arbitrage is. So arbitrage, ladies and gentlemen, before you write anything, assuming that I'm in Kisi, yeah, and then in Kisi, of course, Kisis, we are known for bananas, isn't it? So if I go there and buy some bananas at say Kenya shillings 300, go to the nearest market quite fast and I sell those bananas for 500. So I bought them for 300. Then I sell them for what year? I sell them for 500. I'm able to make in this case here 200 bob as a profit. So ladies and gentlemen, please, anytime they ask you for arbitrage profit, always remember that arbitrage profit is a profit that you earn by taking advantage of price differentials. Price differentials. So price differences between what year? Between markets. Just a minute, I retrieve some notes here. Great. right there that arbitrage is the process where, first of all, I want to know whether we are together. Before I continue, let me know whether we are together. Are we together really? Yeah, God's favorite child. That is really a strong, strong statement. Just like the one that I normally use, we shall overcome. We shall overcome. So arbitrage is the process where investors exploit. Arbitrage is the process where investors exploit price differences between similar assets or farms by buying undervalued and selling overvalued investments to earn a risk-free profit. I repeat, arbitrage is a process where investors exploit price differences between similar assets or farms by buying undervalued and selling overvalued investments to earn a risk-free profit. Arbitrage is a process where investors exploit price differences between similar assets or farms by buying undervalued, like I bought the bananas in Kisia for 300, sold them in Migori for 500. So by buying undervalued and selling overvalued investments to earn a risk-free profit. Thank you so much. Great. Now, ladies and gentlemen, I would want to make this question so easy in a way that you will never, ever forget. So mention there, basic steps. Always follow this structure. Once you have the structure right, then you can never go wrong. Number one, sell all shares. Do you have? In this case here, they are 10% in this question. You sell them, all of them. Step number two, you borrow, because it's equity and debt, you borrow same percentage of company debt. Same percentage of company debt. So basically here you have realized your equity. Here now you have your debt. Yeah, invest total. Number three, invest total. That is equity plus debt you have in the other firm. I hope they're able to take notes. So number one, sell all holding, you sold it. Number two, you borrow the same percentage of company debt, which is D. And then you can invest the total. Now the total cash you have will be the equity plus the debt. So you invest this in the other firm, and then number four, compute ownership in the new company. Compute ownership in the new company. Compute ownership in new company. That is number four. Number five, compare incomes. Compare incomes to ascertain arbitrage profit. To ascertain arbitrage profit. Compare incomes in order to ascertain arbitrage profits. So whenever you hear about arbitrage process, This is exactly what we shall be doing. And this is what I want you to do now. So I'll give you exactly 3 minutes. You think through. Yes, Thiongo, I'll be able to do that. Caught in traffic, we shall overcome. Yeah. So then I want you ninjas to go through this question and try doing that structure. We see how far you can go with this N marks, 3 marks. And of course, we must finish this question really. It's very, very important. You have to finish this question. All right. Now, ladies and gentlemen, after you guys have attempted it, I believe not in vain, can I now go ahead and solve the question myself? Can I go ahead and solve the question myself, my good students? Shall I go ahead and do the question myself? I can't hear these students. Where are they? Where are they? I can't hear them. Are we here, ladies and gentlemen? Are we here? All right. I think I got an internet issue. Are you able to hear me now? Are you able to hear Mwalimu now? Thank you so much. I got into an issue with my internet. Thank you so much. All right. Now we finish this. In just 10 minutes, we shall be through with it. Maximum 10 minutes. Or would you recommend we do it tomorrow? What is your recommendation? Do you want us to just do this? We finish it now, or do we do it tomorrow? What's your recommendation? Now with assignment today, tomorrow, now. Let's just finish it because I can see now they have it. Yes. So then the very first thing, ladies and gentlemen, that we'll need to do here, yeah, before we start our arbitrage process, you can see here using suitable computations, demonstrate how Modigliani and Miller approach without taxes and investor holding 10% of Sigma here, will be better off by switching his holding to Delta Limited. So you can see they have given us number of ordinary shares and they've given us market price per share. The first thing whenever I see NOS and I'm able to see market price per share is to multiply the two. You multiply the two for you to get total farm value. For you to get total equity, total equity. So first of all, give me the total equity. So we have then, what I'll do here, this is what I have, my good students. This is what I have, my good students. This is what I have, my good students. I can see I have sigma. I can see I have sigma. Then I have delta here. Sigma and delta. So they have given me number of shares. they have given me number of shares. So I can see here they have given me number of shares. These are 80 million. And then this other one, my good students, I can see we have 120 million delta. And then they've given me market price per share. So sigma, I can see this 20 and this is 12. So are you able to give me the total share value, total equity value? So you multiply the two, isn't it? You multiply the two. Is there somebody who is able to do that really? Anybody who is able to do that pretty fast? So the first one is 1600. Thank you so much. The second one will be 120 times 12. Sigma 1600, delta 1440. 1440. And you see, whenever it comes to marking your exams, we are normally very fair. But you shall never ever blame KASNEB. You shall never ever blame KASNEB. If you do that, then you are really messing up. KASNEB is a very, very fair examining body. So for example, if you look at the solution here, I hope you're able to see. You'll be able to see, for example, anybody who wrote market value of equity, MPS times number of shares. Tamak. Yeah. You can never, never. So, ladies and gentlemen, that is really, really good. Now that I've been able to get equity and I happen to be having debt, the next thing will be for me to do a summary, that summary table. Please give me that summary table. I know you'll be able to give me that summary table. I show you where you'll be able to get some free marks. Summary table. So summary, so we have two organizations. We have sigma, we have delta. So in this case here, we have total value. All right. So we have debt. Then we have equity. Here, I'm very lucky because I already have the equities. Already, I have the equities already. Already, I have the equities. So the equity, they are here. So equity for sigma is 1600. I can forget the millions. Equity for delta is 1440. I have the debt amounts. If you look at this question very well, we have the debt amounts, don't we? I'm 100% sure that we have the debt amounts. We must be having the debt amounts. They are calling these debentures. They are calling these debentures. So the debt amounts, you can see them here, 8% debentures, 50 and 0. So you can see value here, 50 sigma. Sigma is 50. Sigma is 50 million debenture. Delta is 0. So can you kindly give me the total value? Remember, in this summary table, total value will be debt plus equity. So this will be 1650. This will be what here, somebody? 1440, like that. It's very, very important for you to do always this summary. Very important because it can give you marks and make you see places that you have never seen before. That summary is important. It can make you see places that you have never seen where before. Like here, you can see here, market value of the firm, value of equity plus value of debt. You can see here, yeah. So out of 8 marks, you can end up getting, and you can see it is any, whatever 8, and even these ones, they are among the any, like now 1, 2, 3, without even knowing what we are doing. Now from there, now we start our normal processes now. I hope you remember now our processes. Once you have done the summary table nicely like that, now you begin with our processes. Now, ladies and gentlemen, Remember, we own what percentage of sigma? What percentage of sigma do we own? It is, check this. You see, it is debt plus equity, total value. Total value is debt plus equity. So it'll be 50 plus 1600, giving us 1650. Are we okay? We add, because you see, the other, I know what is confusing this gentleman. The other one, we were given total value and the debt. So we wanted to get equity, so we subtracted. But you see now this time round, we have debt and then we have equity. And we know that total value is debt plus equity. Debt plus equity. All right. Now with the permission, remember sigma, we have got what percentage of sigma? We have 10% of sigma. So step number one, ladies and gentlemen, what have we said about step number one? You shall sell all your shares. So the cash at hand. So step number one, sell your shares, sell shares. So that will be 10% of equity, and equity 1600. 10% of 1600, which will give us what here? Somebody, please talk to me. I only have 7 minutes. 10% of equity, that's very easy. That's very easy. That's very easy. I just want to get 160, isn't it? So we have 160. And then you borrow the same percentage of company's debt. Borrow same percentage of company's debt. So you take 10%. This company known as Sigma that you want to run away from, it has a debt of 50. Debt of 50. Debt of 50. So then this gives me what figure here, ladies and gentlemen? 5. So then in this case here, number 3, total cash invested in the other firm. What is the name of the other firm? Now I'm running away from Sigma. The name of the other firm, ladies and gentlemen, is Delta. So invested in Delta. So I'm taking this cash that I have, my equity, plus the 5, like that, which gives me 100 what here? 165. 165. So now I have 165 like that. Now we have 165 like that. So remember, I'm just following the structure. The moment you understand that structure, you will never go wrong. So they told us they have 10% of what here? Of sigma. It is 10% of equity. Let's read this question very well. It is not a tough thing, really. Not a tough thing. Very easy. So in this, ladies and gentlemen, using suitable computations, demonstrate how Modigliani and Miller approaches with the taxes an investor holding 10% without 10% of Sigma Limited. You own ordinary shares. So you sell 10% of the equity, 1600, give us 160. Step number 2, you borrow same percentage of your shares here of the company debt, same percent, 10. So 10% of 50 gives us 5. So then the total cash invested in Delta will be 165. And then now you go to the 4th step. So the 4th step, ladies and gentlemen, now is for you to compute ownership in the new company. So step number 4, compute ownership in the new company. Compute ownership in the new company. So compute ownership in the new company. Compute ownership in the new company. Compute ownership in new company. So the new company, if you remember very well, you see we are taking there 165. And what was the total value of the new company? Oh, yeah. Are they able to remember the total value of the new company? Total equity value. Total equity value of the new company, which is Delta, is 1440 times 100. Please give me this answer. I know there are students who have another class. So 165 or 1440 times 100, 11.5. My internet is poor today. 11.45. 11.45. Shall we work with 11.45 or 11.46? So we work with 11.46. Now, after that, ladies and gentlemen, let's now compare the incomes. We compare the incomes. It's very, very easy. Do the income statement for these companies now. Let's compare 11.468. So shall we talk of 11.47? Shall we talk of 11.47? Shall we talk of 11.47? 165 over. Okay, 0.46 is good enough. Thank you so much. So then let's compare now the incomes. Let's compare the profit statements, compare the incomes, compare incomes, the P and Ls, right? The P and Ls. So we have sigma, this is the last step, sigma, delta, sigma and delta, the incomes. So I'll be able to share this, ladies and gentlemen. We are comparing the incomes now. We are comparing the incomes. We are comparing the incomes. We are comparing the incomes. Just a minute. I want to compare the incomes and to share the question as we run away. All of us shall be very comfortable. So now we are comparing the incomes. Very easy. This is really easy. So the P and Ls, so you can see profit before interest. So we have here EBIT. So EBIT. So EBIT here is 16,000. Let's put this in shillings thousands. Delta is 16,000. So I want the profit after tax, eh? So come and less interest. Less interest. So interest, if you look at interest, we have 8% debentures and the Sigma has a 50 million loan. So Sigma, it will be 8% or 50,000. I'm cutting 3 zeros, and then the other one does not have a loan. So are you able to give me these figures, ladies and gentlemen, for interest? Oh yeah. Oh yeah, oh yeah. Oh yeah. So this is 4,000. This is 0. So then you are able to give us what we call EBT, earnings before tax. This will be 12,000. This will be 16,000. Now, once we get that, ladies and gentlemen, what do you think will be the next step? What do you think will be the next step? Oh yeah. We less tax. Less tax. They have told us that this is Modigliani Miller 1. Modigliani Miller 1, ladies and gentlemen, does not have any taxes here. That's what they told us in the question. That is what exactly they told us in the question here. Exactly. They told us, ladies and gentlemen, here, there's a place they've told us without taxes. So tax is 0 there. So tax is 0, 0 for the two of them. So you're right. So you are able to give us what we call EAT, or earnings after tax. Earnings after tax. So this is 12,000. This is 16,000. So after we get profit after tax, we shall share this. So now we have our investors. Investor share. Investor share. What amount, what percentage do we own of Sigma? What percentage do we own of Sigma? Oye, niko peke yangu. Sigma tuna own what? 10%. Aka kingine tuna own ngapi somebody? Aka kingine tuna own 11.46%. So 11.46%. Now, because of space, you'll have to allow me to just make some adjustment. So then come and give me the share of profit now. This Kaninja, you see out of the 12,000, 10% ni yake. 12% ni yake. So hapa ana 10% I mean. So aka kanapata, interest is 400, eh? Ngoja kidogo. Wanasema interest is 400. Nilikosea wapi sasa? Actually, is it 4,000 or 400? 4,000, eh? Because it is 8%, 8% of 50,000. Our figures are in thousand. It's 4,000, isn't it? It's 4,000. I don't know why they're getting 400. So are we together really, all of us? Now, please ensure that we are together, all of us. We are together now, isn't it? So share of profits, aka anakula 10% of this, which is 1240 ya 1,200. Huyu atakula 11.46 ya 16,000. 11.46 ya 16,000, which gives me 1833.6 delta. 1833.6, like that. So that is a share of profits here. But now remember, this guy took some personal loan. So less interest on personal loan. On personal loan. Do you remember that he took some personal loan to buy this stake in Delta? Do you remember he took some personal loan? So when he was still at Sigma, the loan was zero interest. Sigma is zero. But you see, Delta, this guy borrowed. And if you're able to remember, he borrowed 5 million, which is 5,000. So he borrowed 5,000, and he's going to get this at the same interest rate that companies are getting at. You see, company here, the company is getting 8%. So 8% of 5,000. Oh, this is what is confusing students. Do you remember this 5 million? Do you remember some loan that was borrowed of 5 million? Do they remember this loan of 5, which was borrowed? Because equity, he got 160. Yeah. And then he borrowed 5 million at the same rate with companies, 8%. This is how we are able to get at 400, which was confusing the students here. So when you subtract, ladies and gentlemen, now we are able to get, in this case here, the very net income. The net income, which basically will be the dividends. The dividends given to this gentleman. So here he gets 1,200. How about here? Here you'll get 1433.6. I know you can see here is getting more. The difference between the two is what we call the arbitrage gain. Therefore, arbitrage gain will be 1433.6 minus 1,200, which will be 233.6, like that. It may look difficult, but trust you me, with practice, you will be okay. With practice, you will be fine. With practice, you will be fine. With little practice, I believe, with little practice, you will be fine. Yeah, so you can see the arbitrage profit here is this. Arbitrage profit is that. Without this, like, you know, Emmanuel, without this alone, hangepata this shareholding, 11 point something. Repeat on the interest part. Interest, you see, so long as you know, we have corporation tax. We have corporation tax on top. Corporation tax was 8% of 50. Yeah, you see, we have this interest here. We have this interest, ladies and gentlemen, here. We have this interest here. Yeah, you can see here this interest. How do we get this interest, ladies and gentlemen, here? We know that the debenture is what here? The debenture they have told us is 8%, which is 0 point what here? 0 point, this can't write very fast. 0.0, no, this is 0.08 times, in this case here, the total loan, which was 50,000. And the total loan that was borrowed was here, total loan. For the so not that one. Total loan for the company is given in the question. You can stop here. It's very easy. If you just go and follow this slowly, you'll be able to understand it. I've tried to portray everything in a very easy way. You see, we have 8% debentures, 8% debentures for Sigma, for 50 million. So 0.08 times 50 million. That is how we were able to get that 4 billion. In shillings, thousands, 4,000. Yeah, that's how we got that 4,000. I've rubbed mine. I suspect, of course, and because you may think that this may come, my suspicion will be like, watch this video later. Ladies and gentlemen, it has been wonderful hosting you today. So I'm looking forward to meeting you tomorrow. I'll be able to communicate to the exact time. Great. And it's my hope you have enjoyed the session. You have enjoyed the session. Great. Thank you so much. Bye.